Hello and welcome to this video on taxation to correct negative externalities. So in this video we're going to describe how taxation, the introduction of a tax, can address the problems or try and correct the market failure associated with negative externalities. So let's start off by reminding ourselves what externalities are. Externalities are the effects of a decision by a consumer or producer that has an impact on the third party. And we've said that they could be positive effects, positive externalities, or they could be negative effects, negative externalities. And in this video, we're going to look at negative externalities and what can be done to try and lessen or solve the market failure that results. So let's remind ourselves of the analysis that shows us the market failure associated with negative externalities. So first of all, what we do is we look at the private benefits and the private costs. And where the private benefits meet the private costs, up until that point is the quantity that will be produced. So here Q market is the quantity of this particular product, maybe cigarettes, that we would get if it's just left to demand and supply, just left to the free market. Now, if that was a good outcome, then from society's perspective, we would still want the same quantity. But when we look at the costs to society, we also add on external costs, the cost of the third parties. And so we have a social cost that is greater than the private cost. And if we assume there are no external benefits, we have a social benefit that equals the private benefit. And if we go through the same analysis, we find that the socially optimum level of output is where MSC equals MSB, and that is here, QSOC, Q for socially optimum output. Now we can see that the level of output the free market gives us is different to the level of output that we want desirably from society's perspective. So the market, the free market here, has failed. It's not given us the desirable quantity. In fact, it has been an overproduction. So too many cigarettes, for example, being produced here. We can go one step further and we can quantify the level of loss to society, which we call the net welfare loss. Now, what we're going to talk about is how a tax on this particular activity might help reduce the market failure that we just explained. So why do governments tax? Well, one reason is to raise money for public services like schools and hospitals and so on. But the other reason why governments tax is to change consumer behavior. And this is the one that we're going to be particularly interested in this section. So we're going to be talking again about indirect taxes. And an indirect tax is one that is applied to the consumption of a good or a service. So you can see where we're going with this. An indirect tax is one that is applied to the consumption of a good or a service, not just on your income. That would be a direct tax. They come in two types. One is a specific tax, and that is a set amount applied per unit. For example, 5p tax on a bar of chocolate is paid regardless of the price of the chocolate bar. It's a set amount per unit. The other alternative is an ad valorem tax, and this is a percentage that is added onto the price and then collected as tax. So for example, VAT of 20% is added onto the price of a car, and that will change depending on what the price of the car is, the amount of tax collected. So why would we impose indirect taxes? Well, we said already to raise money for government spending. Some people think they're preferable to taxing income and wealth. Well, this is a bit of a normative statement. Importantly, this is what we're interested in. We can use a tax to change the level of demand and the pattern of demand for different goods and services. Indirect taxes are also very flexible, it's easy to change, and potentially harder to avoid. So let's now look at our analysis again. We're going to introduce the same concept to illustrate how a tax now can change the market failure. Okay, so first of all, we look at the private benefits and the private costs, and we find that the quantity of cigarettes here would be Q market. That's how many cigarettes we would get produced in the free market. We've said previously that there are also external costs, passive smoking and the burden on the health service. And when we add in those external costs, we see that the output, the level of consumption of cigarettes we want from society's perspective is much less than the level of output that we get from the free market. So people are buying more cigarettes than we would like them to. Now, what we really need to do is we need to make the private individuals here think more about their costs in relation to the social, in relation to society. So if we were to do that, what we would be doing is saying, can we use a tax to increase the costs to the individual so that actually the cost to the individual then match up with the cost to society? So if we were to introduce an indirect tax of this value here, the impact of that would be it would affect the private individual. Here the consumer or the producer would be paying this tax. So it's going to increase the private costs. So the increase in the indirect tax would raise the marginal private cost up by the value of the tax. And so what we can see now when we do our analysis is actually when we look at where the private benefit equals the new private cost, that point occurs here. So the free market, the market output position has moved from there to there. And so what does this mean? This means that the quantity that will be produced in the free market is now going to be the same as the quantity that is desirable from society's perspective. Essentially, the free market output is not here anymore. It has been moved to align up with the outcome, the best outcome from society's perspective. So if this is the case, do we have a market failure? Well, by definition, we don't, because the quantity of cigarettes being consumed is the most desirable from society's perspective. So this analysis can show us how the introduction of a tax on cigarettes, or the introduction of a tax on something that an activity that possesses negative externalities, can alter the habits of the private individuals in such a way that the quantity they then produce matches the quantity we want from society's perspective. So here is another diagram, same sort of analysis, but here the tax that we've introduced hasn't been quite sufficient. So what we've done is we've reduced what was originally the welfare loss, this red triangle, to a smaller area of welfare loss indicated by this black triangle. So this diagram shows us the introduction of a tax, but it hasn't been fully effective. There's been some reduction in the quantity from Q1 to Q2, but we wouldn't say the market failure has been completely solved because we haven't reduced the quantity all the way to Q star. So we can use this analysis to illustrate different things, a reduction in the welfare loss or a complete reduction in the welfare loss and the removal of the market failure. So the introduction of an indirect tax on the producer aligns their costs more closely with that of society. If the taxation fully reflects the external cost, then we say the externality is not external anymore, it's become internalized, i.e. it's become part of the thinking process of the private individual. And so we can go about trying to solve the market failure through the government imposition of a tax. The next slide here has a nice example of this diagram, which you may want to print out, print screen, print out and then stick into your notes. So let's now think about evaluating this. What are the advantages and disadvantages of introducing an indirect tax? These are good evaluation points. So if we think of some of the advantages, well, the main advantage is here, the level of pollution should fall as output is reduced and the price is increased, or the level of whatever harmful activity is taking place should be reduced. The tax revenue. So now we also have this idea that the government are earning tax and they could use that money to clean up the damage that's been done through the negative externality or maybe compensate the victims. It's good because the polluter who is paying, the consumer or the producer, is paying for the damage that they're doing. And it works with market forces. We haven't had to take a kind of extreme command economy approach and just ban something. You can still do it if you want, but effectively we raise the price and we let market forces as a result reduce the quantity that's being produced or consumed. On the flip side, are there any negatives of this? Well, one of the issues is it's very difficult to quantify the pollution and the damage that's done. How do you put a monetary value on passive smoking? How do you put a monetary value on the burden on the health service? So it's difficult to know exactly how much tax to introduce, and so it's hard to get a shift in the MPC that exactly matches the socially optimum output. Often indirect taxes affect particularly low-income consumers. If we're talking about an indirect tax not linked to income, so it has a heavier impact, a more significant impact on the households of poor people than on the rich. And we might question whether that's fair. Also, if indirect taxes are set really high, it creates an incentive for people to try and avoid tax through illegal measures, for example, bootlegging, where you don't declare that you've sold the product and therefore don't pay or collect any tax. Some more disadvantages: when demand is inelastic, indirect taxes have little effect on people's spending behavior. People are not very sensitive to price and still consume the same quantity. It also increases the cost to firms, making them less competitive if they're trying to sell their products and compete with other countries around the world. Firms might also be fed up with government meddling in their affairs and the introduction of a tax, and they might move to another country where perhaps there are no equivalent taxes. So in this video, we've looked at how taxation can address the problem of a negative externality and also some of the evaluation points. That's it. Thank you very much for listening.